Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
When you rank companies on price to book, for example, or price to earnings, and you form a portfolio of companies that are cheap on price to earnings, and you form a portfolio of companies that are expensive on price to earnings, you track the performance of those two portfolios through time, and you could see that what you expected has actually eventuated.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What can football teach us about investing? And I'm talking about the real football where you have a ball and a foot. And what key principles do students need to prepare them for a career in finance? Joining me today to talk about all of this and more is Slava Platkov. Hello, Slava.
Hi, Phil. Nice to be here. Thank you for having me.
No, thanks very much for coming on.
Yeah, of course.
Slava Platkov is a senior portfolio manager and vice president in Dimensional Sydney office. He joined the firm in 2012 after previously working for a large Australian superannuation fund and a large global investment consulting firm. Slava is also an adjunct lecturer at Macquarie Business School where he teaches investment management and corporate finance subjects. So Slava, let's start with your background and how you first came to Australia.
Yeah, so Ukrainian. I was born in the Ukraine. So it's a country no one knew much about until recently, obviously. And yeah, we came to Australia in 1994 when I was 13 years old. And, you know, my parents were very young. They were in their mid-30s at the time. My mother's side of the family came with us here as well. Yeah, I had to we spent the first maybe 6 to 12 months learning English as a family, and then I went into year 8, and then that's sort of how that happened.
Was it a difficult transition? I mean, I know from my parents coming from after the 50s that the immigrants that came to Australia, it was always tough. I mean, it always involved a lot of hard work, didn't it?
Yeah, I think it was a lot more difficult for my parents than it was for me. You know, they like I said, they were in their mid-30s. They're both educated. They were professionals. And they had to give a lot of things up to come here, and then they have to learn a new language, and the work that they started doing was completely different to what they were actually qualified in doing, just because you had to get out there and start earning money and move forward. So that would have been really difficult for them. For me, it wasn't too bad. You know, you're 13 years old, you pick up the language pretty quickly, and then I was a pretty sporty kid, so I ended up making a bunch of friends playing sport, and it wasn't too bad.
When did you start playing football, as we're going to call it through this episode?
Football. Yeah, so I played it when I was very young back in the Ukraine. Interestingly, when we came here, when I was 13, the school I went to, not many people played football there. So I actually didn't play it for a good 3-4 years, so from about 13 to maybe year 11 to maybe 16. I was playing basketball as well because I just wanted to make friends, and whatever everyone else was playing, I wanted to play too. But then, I shifted schools. I went to a private school in year 11 and sport was compulsory. So winter sport, do you want to play rugby or do you want to play football? Obviously, I chose football, and that's kind of how I started playing back, and I got pretty passionate about ever since then.
And you played at a professional level as well, didn't you?
Semi-professional. So like the state league level, if you like, in New South Wales. Yeah. The evolution of football in this country, it's gone from very being ethnic based to, the A-League is now being a professional league. And it was very similar at that state league level as well. You had clubs with, Portuguese groundings, you had, Greek clubs, Italian clubs, you had, Turkish clubs, what have you. So it was generally funded by the community as well, the existence of those clubs. So it was really cool. As some big rivalries as well. It was
the rivalries were very passionate, weren't they?
Yeah, they really were. But nowadays it's quite different. So my son actually he's 12 years old, he plays for a club that I used to play for. But it's a very different connection because that ethnic connection is kind of gone now. They're properly funded entities now. Yeah.
So were you playing at the same time that you were studying at university? And did you study finance? You did study finance, didn't you, at university?
I did. I went to University of New South Wales. My commerce degree, the two majors there were finance and actuarial studies. I was playing football throughout that time. And then as I went out into the workforce, I was all through my 20s, basically. I was playing semi-professional level football. My wife, I met her at 25. we got engaged at 28. By that stage, my football career was well and truly done.
So when did you first become interested in investing? Was it on a personal level, or was it through your studies and understanding that maybe that this could be a career choice for you?
Yeah, through my studies and through my studies mainly. I finished school in '99, and at that stage I started university straight away. The internet wasn't as popular; it wasn't as sort of prevalent at that stage yet. So it was actually quite difficult to get information around, what is investment management, because there's so many different types of investment management that's out there. And I was also doing actuarial studies, so that's a completely different world. Like, what do actuaries actually do? I knew they were making decent money. I knew it was very technical, but what is it actually? So it wasn't easy to get that information. There weren't too many people around that you could talk to, and like I said, internet wasn't as prevalent. So it's much easier for people now. But but through university, you start to learn economics, you start to learn finance, and then you've got your parents, and they're all asking you, okay, you learn about the market, and then you start to go, okay, I could actually enjoy giving people advice or managing people's money. That would actually be quite a cool thing to do, to help people sort of grow their wealth, to help people make decisions about, in times where markets are going through difficult periods in particular, helping people making decisions around those times is really, really important. And that started to come to me. And now it's kind of gone full circle, because at Dimensional, at a high level, that is the main reason why Dimensional has been so successful globally over the years, because they've established such a strong connection with the advisor clients that they work with. And that connection is really based on the premise that we will help you, the advisor, communicate to your clients, particularly during periods of uncertainty, because that is when you earn your stripes as an advisor. And we, as an independent manager, will help you. We'll do everything possible for you to, do your job to the best of your abilities during those periods. So it's kind of, as you mature through your career, you realize that it's all coming around for full circle.
And actuarial studies, because there's a lot of fundies that I've spoken to who've got an actuarial background, because it gives you a real grounding in risk as well, doesn't it?
Yeah, it's technical. I mean, to be honest, the university, the bachelor bit for actuarial is only the first step. You have to, come out of your bachelor degree and do a few more stages to become a qualified actuary. I didn't pursue that. But the technical background is really important. You learn a lot about how things are priced, how different instruments work, so derivative instruments, for example, so some of the more complex stuff, different payoff structures. And yes, to your point, you definitely learn a lot about risk and how to measure it and what it means. So that definitely came in handy.
Now, Dimensional's not very well known in Australia, although it's a very large company internationally, isn't it? Tell us a little bit about Dimensional and its role in the Australian market. Yeah,
it's such a great story, very unique in many respects. We manage $1.4 trillion Australian dollars globally. So I think we might be in the top 20 in terms of global fund managers, but I think we're one of very few in that top 20 that are still privately owned. And that's very much sets out the culture within Dimensional. So we started in 1981, which is the year that I was born, coincidentally. We started by our founding principal, David Booth, realized that there is a bit of a gap in the marketplace, in the institutional marketplace, so the large pension funds in America. He realized that they couldn't get exposure to the very small companies that are out there in the marketplace. And the reason they couldn't get exposure to it because they didn't know how to implement it. They didn't know how to trade them. They didn't know how to define what they are. And they didn't know how to sort of manage that portfolio continuously to make sure that that exposure stays the right exposure through time. And that's the solution that he came to in the marketplace. He through really careful implementation, through being really flexible around which companies and being really thoughtful and deliberate about how to get that exposure, he managed to win some business from the large pension fund in the US and manage a microcap, the first microcap portfolio, if you like. Interestingly, the first 6 or 7 years, I think it delivered horrible returns. So it would have been pretty tough at that point in time. And then after that, the whole world of asset pricing, which is really where really smart people, academics, are really trying to figure out what drives returns. What drives returns for equities, or whether it's bonds as well, or different other instruments. What can I say about the future returns of those companies by looking at the current information that I have in front of me, which is basically prices and fundamentals. So that's how the asset pricing world started. And a really important paper that came out in 1992 by Professors Eugene Farmer and Ken French, which are actually the founding principles of our business as well. It's those ideas that our portfolios are based on at the moment at Dimensional. That paper came out in 92, and it said that on average, exposure to small caps tend to deliver higher returns than the broader market. They also said that on average, an exposure to cheap companies or companies trading at a discount, value companies, also gives you higher returns. So they called it the 3-factor model, which is where you can get exposure to the broader market, but you can also overweight or emphasize companies that are small and cheap. And that should give you a superior return relative to just the broader market. And that additional return is really worth pursuing, because if you look at just one percentage on, like, just call it $1 million, if you extrapolate that forward and you earn that 1% more and you compound it for over sort of 10, 20 years, you end up with 20, 30% more money at the end of that period. There was some really strong impetus as to why you would want to target those small value securities. That was the big, very important point in the existence of Dimensional in that sort of mid-90s period, where we started managing a bunch of small cap and a bunch of value portfolios for clients. From a business perspective, it also coincided with our foray into the advisor world, and that's where the majority of the capital that we manage now globally sits. It's 70% or so of the money, of that 1.4 trillion that we manage, is advisor money. And the reason that we became a fee-for-service model. So where, we wanted to partner up with advisors that weren't getting any rebates or kickbacks from fund managers, or weren't getting any kickbacks from various insurance companies. They were just, this is how much money I manage for you as a client, and this is how much I'm going to charge you for managing that money. And that model where you've got a fee-for-service advisor, independent self-licensed advisor, you've got a client with their savings or their pension money, and then you've got an independent fund manager that's helping the advisor to form that portfolio and take their client through those difficult. That became an incredibly powerful combination, and that allowed for us to thrive as a fund manager, and here we are.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
We often hear that the smaller end of the market, the small, mid, micro caps, is where the outsized gains are, and it's where smaller investors can outperform other managers because there's less competition in there. But how do you find it? I mean, presumably the position sizing would be difficult to manage because you've got a lot of dosh to deploy as compared to a smaller investor. How do you manage that?
Yeah, well, the percentage of your typical portfolio that gets allocated to small caps, for example, is smaller as well, because, as you say, it is a smaller part of the broader market, right? So it's proportional in a sense. You may have an overweight because you think that part of the market has good prospects, but it's certainly proportional in that sense. What is really important is the systematic approach that we carry out. We're not after any particular small cap at any point in time. What we're trying to do is cast the net really wide across all of them, right? Particularly if they are also profitable small caps or small caps that are trading at a discount. Those three combined is almost like our holy grail. That's where we want to have the biggest overweight or the strongest exposure, if you like, those type of small caps. But we want to do it systematically across as many of those type of securities as possible, right? And that allows for you to be very cost effective. That flexibility where, today, this particular small cap isn't trading with a lot of volume and it's expensive to execute. So I'll stay away from it today because there's 20 or 30 others that are giving me very similar characteristics. They're all trading at a discount. They're all pretty profitable. And I can just focus on trying to execute those instead, right? So that flexibility, being able to cast the net wide and sort of work in groups of companies in a diversified fashion, that really allows for us to get exposure to that asset class cost effectively.
Are you looking at the sectors that they're involved in as well? I'm sure you're looking at so many metrics, because you have to really do, when you're casting the net widely, you've got to be looking at which sectors are going to be working and outperforming. Does the sectors that you look at change over time? And are there any sectors that you particularly like at the moment?
Yeah, absolutely. And the structure that drives the distribution of your portfolio across sectors is really the overweight that you have to small value and high profitability security. That's the main objective of most of the portfolios that we manage. So that's the input, if you like. The output is the distribution across sectors. So at the moment, for example, if you just look at markets globally, there's generally a fair bit of consistency across the world. You know, sectors like the materials, sectors like energy companies, they tend to be screening better across those three metrics, right? So particularly valuation and profitability versus, you know, some of the investment information technology or consumer discretionary companies, for example, they tend to be at this point in time more expensive and not as profitable. Right? Therefore, you look at our portfolios, and given that you've got that transparency in terms of what we are trying to achieve over time and the exposures that we're trying to deliver to our clients, you expect for our portfolios, therefore, at this point in time, to be overweight materials, energy, and underweight, you know, information technology and consumer discretionary. But that can change through time, right? You know, 10 years ago, you know, or 8 years ago or so, banks in our Australian equity portfolios, for example, the banks were screening pretty attractive because they were pretty cheap at that point in time. Now, you know, we've got, you know, it's so well documented how expensive CBA is and some of the other banks as well. So the sector rotation is very much part of, you know, realizing this value and size and profitability premiums in your portfolios. And we have to react to those changes, adjust our portfolios accordingly, and deliver those exposures consistently to our clients. Yeah.
So I've noticed that a lot of the work is factor-based investing.
Yeah.
Can you explain that for listeners and especially for beginners in a very simple manner?
Yeah, I'll try. I think factor is just a metric. It's just something that you can rank securities on. Right, so the more common one, there's so many of them out there in the literature. I mean, there was a paper that came out a few years ago called the Factor Zoo. I think it identified something like over 300 different factors or metrics that, you know, you can rank companies on, and they generate some sort of a difference in return, right? Because that's what you're trying to do.
So these are particular factors. You look at them and you say you can assign a return based on that factor.
Well, you rank on that factor. Let's just say an easy one would be market capitalization, right? So how large price times shares outstanding, how large your company is. So if you rank on market capitalization, so market capitalization is your factor, right? But is there a factor premium, right? When you rank on that factor, is there a group of companies that outperforms its counterparts? And that's a factor premium. So if small caps, for example, as a group perform stronger than large caps over time, that becomes a factor premium. Now, what you don't want is you don't want to just do, and this is why I was talking about the factor zoo, you don't want to just try any single metric and to see what works, right? That would be data mining, and that's not very reliable, right? What you want to do is you want to have some fundamental expectations around why a particular factor should even exist to start with, before you even look at the data historically. Right? So why should a value company perform stronger than, you know, a growth company? Well, it could be a risk-related story. It could be valuation-driven, like the valuation theory-driven. Yeah, so you want to have some expectations behind what factors should be out there. You should expect to perform better. And then you want to do the ranking and test it all out historically to see whether that's actually been the case. And that's exactly the criteria that we apply at Dimensional. So we think first and foremost, you know, why these factors should exist. And generally that's based on valuation theory. So the expected returns that the market applies to different securities are always going to be driven by prices or cash flows, right? So from a price perspective, all else equal, a cheaper security should deliver you a higher expected return. A smaller security should deliver you a higher expected return. Also, all else equal, a security with higher cash flow should deliver you a higher expected return as well. So very fundamental, very theoretical expectations. And then if you go back, and we now can go back close to 100 years, because we've got price data in the US going back to 1928, I believe, you can actually see that, you know, when you rank companies on price to book, for example, or price to earnings, and you form a portfolio of companies that are cheap on price to earnings, and you form a portfolio of companies that are expensive on price to earnings, you track the performance of those two portfolios through time, and you could see that what you expected has actually eventuated in a way that is quite statistically robust, where you've got the cheap portfolio outperforming the expensive one by about 4% per annum over the last 100 years. So quite a significant spread. So then a manager like Dimensional, what we're really about is saying, okay, that's quite a significant spread, and that's given us input. If I could just capture that spread systematically through time in a way that is cost effective, that I could deliver that additional return to our clients in our portfolio. And that's really what we've been doing for over 40 years. Yeah.
So I wanted to talk about resilience and how resilience is critical for portfolio management. And I'm assuming this has got something to do with the football, the playing of football as well, because they both require a bit of resilience, don't they?
It does. It really does, yeah, especially the position I played, which was like a defensive centre mid. It was, it required a lot of positional discipline. So as much as in my head I wanted to sort of charge forward or join the attack, if you like, I had to always, there was another voice inside me that was saying, okay, you got to stay.
Restrain yourself. Stay in this
position. And our approach to investing is very similar from that perspective. In fact, everything that we do at Dimensional from an implementation perspective is around generating resilience to our portfolios, because these factor premiums that we're targeting, they're actually really volatile. So you have that 4% return that I spoke about, that outperformance, if you like, for value versus growth. That's a 100-year number. The reality is the way it's realized is in a very volatile manner. And so it should be, right? You're not going to earn a premium if you're not going to bear the risk, right? So everything that we do from an implementation perspective in terms of our portfolios is trying to figure out a way, how can we protect our portfolios from that volatility? How can we make them more resilient, right? That's what we're trying to do. And some of the main things that we employ there are things like diversification is a really important one. Right? So, casting the net really wide. That way you're just spreading your risk across as many stocks as possible. So that's a really important one. The other one that we do is we try to integrate these signals. So we're never just we don't want to be just overweight all the value company in a naive way or all the small cap companies. We want to make sure that we overweight value companies that are also small and are also profitable. When you combine those signals, the resilience increases in your overall portfolio. And then the final one is just flexibility when it comes to implementation, having optionality. So being able to say, okay, these two stocks today, as much as their characteristics are good for our portfolios, let's not trade them today because they're too expensive to trade. So maybe there's a downward momentum characteristic that's coming through. Let's stay away from those today and let's focus on the other ones. So that optionality, and which really comes from us being trading every single day, our portfolios, and being really diversified, that's huge for the overall resilience of our strategies.
And Dimensional as a company, you mentioned before that you're mainly focusing on advisors and directing these funds to the advisors, but there's a dual nature with ETFs, isn't there, that anyone can buy them?
Yeah.
How's that managed?
Yeah, that's an interesting story. The business model and the reason it's been so successful with the advisor market, and you may know this, Phil, is we used to control access to our funds. Right? Yourself cannot invest in our funds unless you go through an advisor. For your advisor to invest your money in our funds, right, the advisor would have to go through a bit of an induction process where they learn about how we invest, right? And generally they come out of that process fairly aligned with our way of investing, which is all about, controlling things you can control, diversification, longevity, so long-term investing, right? Being really prudent around market inflections and how the decisions that you make around that. That's what our approach is all about. So advisors come out of that pretty well aligned. And generally what that means is they, on the back of that, allocate a reasonably large chunk of their clients' portfolios into Dimensional funds, right? And that's worked an absolute treat for us. Now, to your point, there are some really good, the ETFs, which is another access points to the same portfolio, because we've launched dual access ETFs nearly 2 years ago and some more last year. There, all of a sudden, we don't have that control anymore, right? We can't, because anyone can just buy a stock, right? But what we're seeing is still the take up into our ETFs is still coming from the same advisor clients. So generally speaking, it's still people investing in our funds with the right intentions and with the right investment sort of know-how, if you like. It's just a different access point in terms of investing in our portfolios. Yeah.
No, that's interesting. So you oversee a diverse range of strategies from equities to REITs, which are real estate investment trusts.
Yep.
What's the different approaches and the unique challenges of managing multi-asset portfolios? And also, what are the strengths of them as well? Because diversity is not just in the market, it's in share markets itself. It's across a whole range of asset classes, isn't it?
Absolutely. And we also manage fixed interest. We've got probably somewhere between 200 to 300 billion globally in fixed interest portfolios. We've got infrastructure, global listed infrastructure portfolios as well that we manage. So, and that's one of the reasons why we've been such a great solution for a lot of our advisor clients in particular, because they can, in theory, form a portfolio for their clients just using just dimensional funds, right? We give them access to the entire asset allocation, equities, fixed interest, REITs, infrastructure, the whole portfolio, which is very convenient if they want to go down that route. But conceptually, irrespective of what asset class we manage, the approach is the same, right? It's systematic, and it's really trying to extract information from current market prices. Whether in equities, whether we're ranking on price to earnings and seeing, where is that security in the ranking? Should it be overweight or underweight? Is it cheaper? Is it expensive? Is it small? Is it large? Is it profitable? Is it low profitable? In bonds, we're looking at yield curves, which is market prices as well, to tell us whether we should be targeting longer term bonds or shorter term bonds, government bonds versus corporate bonds. The approach is the same. We're not outguessing prices. We're not timing markets. This is a systematic approach where we're extracting information from current prices about what the future return should look like. And we are readjusting our portfolios accordingly. The difference, and this is the challenge really, is in the infrastructure that's required to do that. Because when you are managing an equity portfolio in Australia, we're talking about 500 odd securities that we work with there. Whereas if you go to a developed markets portfolio, we're all of a sudden talking about 6,000 securities. If you're talking about fixed interest portfolios, we're working across sort of 20,000 on bonds that we trade across. So the infrastructure behind, absorbing that data from different vendors, organizing that data, making sure that it's clean, making sure that it's consistent, making sure that it's enriched from different vendors, and then piping that data through into our portfolio management systems for us to be able to operate every single day. That's really the difficult part. But in terms of investment-wise, conceptually, there's a lot of consistency about how we approach all of those different asset classes.
Take control of your investments. ShareSite has you covered. It's Investopedia's #1 tracking tool for DIY investors. Get 4 months free on an annual premium plan at sharesite.com/shares for beginners. What would you suggest for investors to consider when they're looking at different asset classes? I mean, I always say on this podcast, have a look at your superannuation and just see what the asset allocation is, because most people think assets, stock market, it's very simple. But there's many, many different ways of looking at it, and very many different ways of weighting your portfolio. And I think your superannuation is a great way to start looking at what a conservative is, conservative balance fund, and so forth. And these are all very for a beginner, they're very complex concepts.
Yeah.
Just give us a little bit of an overview that might simplify this for listeners.
I couldn't agree with you more. I think my first advice would be to go get an advisor. Go get a professional advisor. I think people absolutely need advice. Whether you've got $500,000 in your superannuation or whether you've just sold your business and you've got $10 million, either way, I think, you can really destroy your wealth by making bad decisions. Markets are so volatile. They're so unpredictable. There is so much to understand. We've got some advisors that work with some of the smartest people out there, doctors, lawyers, and they just don't know how to invest, right? So it's really important. My first advice would be to just get an advisor. If you can't, to your point, looking at a simple superannuation solution, and we are in this country are quite fortunate to have such a big superannuation market, looking at what they're offering in terms of their portfolio is a pretty good reference point. You just need to understand, things like costs and et cetera. But that's not a bad start. But there's a couple of really key principles for you to sort of understand, and anyone can really understand it. The first one is the split between your growth and your defensive assets is going to be the main driver of what you're going to you ultimately receive as an investor in terms of return, right? And the really simple concept there is the more equities, which is a lot more volatile, the more volatility, the more risk there is around your return outcome. So maybe if you're 20-year-old or 25-year-old, you're not very sensitive to that volatility because you've got a long time until you get that money. Maybe that's the way forward, right? And generally what you see is the younger investors have mostly growth portfolios, growth assets in their portfolios, which is predominantly equities. As you approach retirement or as you becoming more sensitive towards volatility, you should start to introduce some defensive assets into your portfolio. And once you get to a pension stage, majority of your portfolio should probably be in defensive assets. So that is the one key principle to understand. Depending on where you are in life and how sensitive you are to volatility, get that growth defensive mix right for your risk profile. And that's an important first step. Once you're in there, it really does become mainly about things like costs and really just how much conviction you've got in the underlying managers that are managing that money for you professionally. Do you want to go with a traditional approach, which is where managers are exercising judgment, they are reaping above balance?
These are fund managers, aren't they?
Fund managers, traditional managers that are trying to outguess price and trying to make really big subjective calls on various companies or markets that they invest in. Do you want to go down that route? And generally you pay much higher fees for that. And the outcomes as a cohort for that group are pretty unsuccessful. Do you want to do an index approach where it's very much hands off and very cost effective, where you're just tracking a particular market? You get a diversified portfolio, low turnover, low cost, not a bad way to start, but obviously you're not getting that additional return there as well. Or do you want to do something that Dimensional do, which is systematic, which is kind of your portfolio looks a little bit like the index, plenty of diversification, very cost effective, low turnover, but you are trying to deliver additional return over and above the index, like the traditional managers. You're just trying to do it in a more of a reliable, systematic fashion.
Yeah, there are some who say that the best predictor of returns is the lack of volatility in your portfolio because you don't get tempted to sell when you're panicking.
Yeah, exactly. Yeah. We've got some, again, just going back to how we work with the advisors, we almost ramp up our communication and our service levels when markets go through periods of volatility. We had one back in April, those 4 days, the Liberation Day, when Trump came out with all those commentary around tariffs, markets fell by about 8% over a 4-day period. We, ramp up our efforts in terms of the sales team and the client service team to go out to advisors and say, okay, your portfolio used to be a 50% equity, 50% fixed income portfolio, is no longer that because the equity markets have fallen 10% or so. So you need to readjust. So make a good decision for your client. And that would have, if they were to rebalance out of bonds back into equity at that point in time, the equity markets have rallied back and that would have been really good outcome for their clients. So those type of situations are really important. Like I said at the very start, that's where the advisors earn their stripes.
Well, let's talk about your teaching career. What's it like? I mean, you must get a lot of bright young things coming into the classroom. Does it give you optimism for the future? Yeah, I really enjoy it. There's actually nothing more rewarding than educating, teaching someone something new and clearly observing their level of satisfaction that they've just absorbed something new, they've learned something, and they feel good about themselves for doing that, and that's very rewarding. My job at Dimensional, a big part of it is about communicating as well. So that's also teaching helps with that as well, because I always think about, how do you convey some of the more complex concepts in a way that's absorbable. But yeah, and it is a responsibility. They are teaching a master's course in particular. These are people that have been working in a particular industry for some time already, and they've made a very deliberate decision to change careers or to progress their careers, and they're paying money to do that, and they're allocating their time to do that. So it's a big responsibility to make sure that they have a good experience and they get what they want out of it, and hopefully, successful at making that next step. So it's a big responsibility as well. Is there anything that you notice that they need to unlearn? Any common misconceptions that people come into the course with? Yeah, I think, the softer skills are often put aside because it is a technical field that we are talking about, finance, particularly masters where they're quite technical and strong and they feel like that's what it's all about. But the reality is sort of, being curious, being able to work in a team, being able to communicate some of those
being able to sort of take ownership of things, ask questions, have initiative, those type of skills are just as important. And that's kind of where, again, you could draw a lot of parallels. Your corporate life draws a lot of parallels between a football field, where you kind of need to, you almost need to respect the fact that other people's brains work differently to yours, right? So you need to find that bit of patience, and you need to respect the fact that your expectations are not the same expectations as other people. You need to learn how to stay in your lane. You need to learn how to delegate. All those things are, those softer sort of things might be missing a little bit, or at least they're down-weighted relative to the technical skills that master students generally think that it's all about those technical skills. It's not necessarily.
Yeah, I've noticed there's quite a few people who change careers. They come from something completely different, retrain, and get into the finance industry because they started getting interested in investing on their own behalf, and it became a passion for them. So it's something that can be done, isn't it? It's not. Absolutely. It's not a closed factory floor.
No, absolutely. Some of the better people that we've hired had similar experiences to what you described. They've not necessarily...
And they can come from a completely different background, and that brings something as well to the industry.
Exactly. I mean, Dimensional was founded by sort of academics. A lot of the first people that we hired, because we're carrying out a process, some of the first people that were hired were just technical people, like scientists, mathematicians, engineers. But if you look at sort of how that's evolved through time, the recent past is really about people who, more investment people, if you like, people who can communicate, people who can work in a team, who can collaborate. Yeah.
So you run 34 funds, I believe?
We run 34 commingled funds. Yeah, we've got some separate accounts that we manage for our institutional clients as well, yes. And it's about $65 billion in Australia that we manage.
So how can listeners find out more?
Well, there's the website, obviously. They could listen to this podcast if they want as well. They can type in Dimensional ETFs in their Google tab, and they could get a bunch of information from there also. Yeah.
What kind of expense ratios are involved?
These are fairly low-cost solutions. So we're talking about... It depends on the strategy, but anywhere between sort of 20 basis points or even like 16 basis points. Some of our sort of lower octane equity portfolio, 16, 17 basis points. And then it goes up with the amount of, the different markets that you introduce into your portfolio. It goes up with how much of an overweight that you have to size, value, profitability. So, and it goes up with how higher of an octane is your portfolio. So if you've got a very definitive objective, like if you just want small caps or if you just want value stocks, price tends to be a little bit higher. But we're talking, 17 is probably the cheapest. Our emerging market portfolio or our small cap portfolio is somewhere around 50, 60 basis points. So, fairly low cost solutions overall. Yeah.
Okay, so the big final question, where's Ange Postecoglou going to end up next?
Who knows? I feel bad for Ange. He was found out a little bit. He did win the Europa League. He won the first trophy for that club, first time in 17 years, I believe. But he's also lost 22 out of 38 times during the Premier League season, which, if I'm the club owner and I'm thinking, all right, I'm going to give this guy responsibility with a fair bit of money to buy new players and go into next season, that's a difficult decision after losing 22 times. So I understand that decision, but I also feel bad for Ange. But look, his teams play amazing football.
And it's a very aggressive form of football as well, isn't it? Very
aggressive. There's a very strong identity there. There's going to be plenty of club owners who will want to try Ange out. He's not going to be out of a job for a long time, I'm sure of it.
And it's also a lesson for investors about the level of aggression you bring to the game, I guess.
Yeah, you need to make sure you do some risk management as well. Definitely.
Slava Platkov, thank you very much for joining me today.
Thank you for having me. It was a lot of fun. I appreciate it, Phil. Thanks.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.